So, welcome to the Monkey Stock Club. For those who are new at this channel, my name is Monkey B. I love to go out there and finding some nice stocks just for you. So all you have to do is just watching this video and decide if the following stock could be something for your portfolio. It doesn't get much easier than that. In return to that, please feel free to hit the subscribe button below and become part of the Monkey Stock Club family so you will never miss a video again. Please be aware that everything I say here is just my opinion, as I'm not a professional investment advisor. As you can see, I'm just a monkey, but nevertheless, I love to analyze stocks just for you. So let's stick around and discuss some numbers now. So to analyzing the stock, I use the high growth investing strategy. It consists of 6 KPIs. For every KPI you can get 0 up to 3 points. So in total, a stock can get a maximum of 18 points, and this indicates a high growth stock. So today we're going to do a comparison between PFIZER and Merck company. We will do 3 steps. First of all, we go through the high growth investing analysis for both companies. In the second step, we will do a quantitative analysis strategy with 6 KPIs for both companies, and at the end we will calculate also a fair value for both companies. And last but not least, we will nominate one of those suppliers as a winner. Drop the like button for the YouTube algorithm if you like this video, and stick around for the entire video, because I think at the end of this video there will be beneficial information for you, and that could help you to invest either in PFIZER or in Merck. So let's get started. So to be honest, most of the videos they mentioned that you just take a look into the Yahoo Finance figures and calculating all the stuff, all the KPIs, to have a clue if you should invest in one company or not. To be honest, most of the people are getting crazy when they see all these figures, and that is why I'm here. I'm trying to do my best to, let's say, doing the work, and that you just looking this video and getting a clue about all the key figures to also analyze stocks and getting an idea if this could be an opportunity for you or not. So first of all, as I mentioned, we will do the 6 high growth investing KPIs, the enterprise value divided by the sales, the cross margin, the rule of 40 score, trailing 12 months, the sales growth, the debit ratio, and last but not least, the price per earnings divided by the profit growth, trailing 12 months. So here on the left hand side you can see the screenshots from Yahoo Finance, and the enterprise value divided by the revenue you can find directly in the valuation measures. For PFIZER 5.2, I put it in here. Then the cross margin is the sales reduced by the direct costs that we can see here, the gross profit divided by the sales, 80%. The rule of 40, the sales growth plus the free cash flow margin. So we use the operating income divided by the revenue, 18.3 points. The debit ratio, 0.94. It's calculated by using the total debit divided by the common stock equity. And last but not least, we use the PE ratio trailing 12 months that we can find also in Yahoo Finance, 23.75 divided by the profit growth of, unfortunately, 0.35 trailing 12 months. So we end up at 68 as the PEG trailing 12 months. Next one is the quantitative analysis strategy. Here below also 6 known KPIs, the return on equity. We just take a look into the breakdown of the income statement of PFIZER. So net income for stakeholders last year divided by the common stock equity in the balance sheet from the last year, and we end up at 25.77%. The EBIT margin, the EBIT divided by the revenue last year, 37%, as we can find also the EBIT and the total revenue. The equity ratio, so we just use the equity divided by the total capital, so end up at 38%, that you can find also in the balance sheet from last year. The PE ratio 5 years, just using the average of the last 5 years, the EPS from the last 5 years, going back to 2017, 2018, and then also including the estimation for this current and the next fiscal year.
and we end up at 2.75 as an average EPS. And if we take a look into the share price, we then end up at around about 13 as a ratio, the PE ratio 5 years, and the current PE ratio, we just using the estimation for 2020, around about 13 as well. And the profit growth is, if we compare 2.84 to 2.83, more or less no profit growth at all. So now we have for PFIZER all the KPIs collected for the high growth investing analysis and also for the quantitative analysis strategy. And now we do the same for the MERCK stock. So I'm just going quickly through the results of the ratios. The EV divided by the sales, 4.74, the cross margin, 71%, the rule of 40, 31%, sales growth 3%, debit ratio 0.73, and the PEG trailing 12 months 1.1. As you can see here in the screenshot, and also marked with the color marks here on the left hand side. And below the quantitative analysis strategy, 38% for the return on equity as the ratio of the net income for stakeholder divided by the total equity. EBIT margin 26% last year, equity ratio last year 30%, PE ratio 5 years, as we have an average of 3.85. We end up, if we divided the share price by the average of the last 5 years, at around about 21. The current PE ratio was around about $6 for 2020. If we divided it, the 80 US dollar share price by the current EPS, then we end up at 30.45. And last but not least, the profit growth, as we do the comparison between the estimation for the next fiscal year 2021 to the current one. So we end up at 6.5. So we also collected all the key figures for MERCK, and now we're doing the interesting stuff. We are comparing, we'll do the comparison between PFIZER and MERCK, and looking how many points they will get out of the 18 points for the high growth investing strategies. First of all, the enterprise value divided by the sales. This is a measure of the value of a company regardless of its financing. And if you divided both figures, then you get an important ratio for estimating the valuation of a fast-growing but still loss-making technology company. So both companies are doing quite well. PFIZER 5.2 and MERCK 4.7. Both companies are getting 3 points as they are below 8. Next one is the profit growth. The cross margin, the cross margin provides a good indication of the profitability of a business model, and the higher the percentage, the more money a company has available for other activities and other stuff like sales, marketing, research. And PFIZER has reached 80%, so they have a lot of money to doing other stuffs. So 3 points for PFIZER, and MERCK are getting 2 points as they are between 75 and 65. They reached 71%, so they are getting just 2 points within the cross margin, and PFIZER are getting 3 points. So in total they reached already 6 points and MERCK 5 points. Next one, the rule of 40. So the rule of 40 is a simple key figure for assessing the efficiency of a company's growth and the quality of a business model. And the higher the percentage, the better the business model of a company is. So everything above 40 could be considered as attractive. As you can see, PFIZER have 18 percentage and MERCK 31%. So both companies are getting 0 points as they are below 40. The sales growth minus 8.28 for PFIZER, trading 12 months, unfortunately below 20, and MERCK just 3% sales growth trailing 12 months, so also 0 points for both companies. Next one, the debit ratio. So the debit ratio less than 1 indicates a low debit, while a debit greater than 2 indicates possible risk for debit and also risk for the finance. So both companies are doing quite well, as they are between 0.5 and 1. Both companies are getting 2 points for the debit ratio. And finally, for the price per earnings divided by the profit growth. So this is, from my point of view, one of the most important key figures for the assessment of an already profitable growth stock. And if this ratio is between 0 and 1, as Peter Lunch already mentioned in his formula, we talking about an undervaluation of a stock. And this could be then a nice opportunity and a nice time to invest in a undervaluated stock. So for PFIZER, we end up, as we take the PE trading 12 months, around about 24 divided by 0.35, the profit grows. So we end up at a huge value of around about 68. So unfortunately 0 points. So we stay at 8 as a final result for PFIZER. For MERCK, we have the PE trailing 12 months, around about 18 divided by 15.5. Profit growth trailing 12 months, we end up at 1.1. So we are getting 2 additional points. Overall, we end up at 9 versus 8. So in the case of the high growth investing analysis, MERCK has one more or one further point compared to PFIZER. So they end up a little bit better than PFIZER. Now just looking into the quantitative analysis strategy, the return on equity, both companies are doing quite well. PFIZER 26 roundabout percent, MERCK 38%. So both companies are getting 1 point, and the return on equity indicates how the equity of a company has earned interest during a financial period. Shareholder can see from the return on equity how profitable his investment in a company is. So both investments are quite well, as we are above 20%, 1 additional point for both companies. So within the quantitative analysis strategy, it's a little bit different. We can reach 1 point, 0 points, or 1 minus point if we are doing quite bad in one KPI. And yeah, let's see. EBIT margin, EBIT divided by the revenue. So high EBIT margin are a quality criteria for the investment risk. So the higher the EBIT margin, the easier it is to manage declining sales. Also in this case, both companies are doing well. The EBIT margin for PFIZER 37%. MERCK are doing also quite good with an EBIT margin of 26%. Both companies are getting 1 additional point as they are above 12%. Next one is the EBIT ratio last year. We take the equity divided by the total capital. So this gives also information about the credit rating of a company. PFIZER 38%, MERCK 30%. So both companies are above 25%. 1 additional point for both companies. PE ratio 5 years, 13 as a ratio around about for PFIZER, 21 for MERCK. So in this case, MERCK are getting 1 minus point as they are above 16, and PFIZER are getting 0 points as they are between 0 and 16. The current PE ratio 13 for PFIZER, also 13 for MERCK. So both companies are getting 0 points as they are between 12 and 16. And last but not least, the profit growth. PFIZER are doing quite bad as they have no profit growth at all, 0.35%. MERCK are doing better in terms of the profit growth, 6.5%. So they are above 5%, and they are getting 1 more additional point for this profit growth. So here the overall results for the high growth investing strategy: 8 points for PFIZER, 9 as I mentioned for MERCK. So they are doing a little bit better in terms of the high growth investing analysis. In terms of the quantitative score, both companies are receiving 3 points. So the return on equity was good in both companies. The EBIT margin was also in both companies quite well, so 1 additional point. The equity ratio also in both companies quite well. For the PE ratio, 5 years, MERCK are getting 1 minus point, but they are getting 1 additional point for the profit growth. So both companies are getting in total 3 points. So 4 points for MERCK, minus 1, 3, and PFIZER just 3 points as a lump sum. So Under these circumstances, from my point of view, both companies are quite good comparable. Both companies are doing quite good in terms of both analysis. And last but not least, we want to calculate also the fair value for both companies. So starting with Pfizer, what I did is just looking into the EPS for back in 2018 for Pfizer 1.87. If we compare this with the estimation for 2021, $2.84 EPS, then we would end up in an average profit growth of 17% roundabout. If we multiply this by the EPS, the estimated for 2021, we end up at around about $49 per share. The current price, that was Monday, $36.5. So we would have a potential growth in terms of the price of 35%. So we are a little bit below the fair price. If we do the same for Merck, looking into the EPS of 2018, 2.32, compare this with the estimation of the next year, 2021, 6.36. So that's huge. We have an average profit growth of 57% for the last three years. And if we multiply this with the estimation for 2021, $6 roundabout, we end up at a fair price of 363. If we compare this with the current price of around about $80, we would have a potential price gap of plus 354%. So that's huge. So finally, who is the winner from my point of view, as we finally see the fair value? From my point of view, Merck is still undervalued. If they are doing as we expected within the next 2 years, then we have a big potential in price increase. From the high growth investing analysis point of view and the quantitative analysis, they are quite good comparable. Both companies are quite good, but nevertheless, I see a bigger potential in terms of the price increase for the Merck company. Yeah, I hope you liked this video. Drop the like button for the YouTube algorithm, as I mentioned before. I also would appreciate if you hit the subscribe button, become part of the MERCK STOCK Club family, so then you will never miss a video again, and I will inform you once a week at least about some news on the stock market, some nice potentials, opportunities, but also some risk in terms of the investments. So have a nice day, and hopefully we will see each other. Bye bye.